Have you ever thought about investing in the stock market? Many of us have given it serious consideration. However, the fear of financial crises, bursting bubbles, and economic downturns often makes us hesitant to proceed. But in any of those situations, there is an actual way to invest in the market that doesn't leave you at risk of losing everything. The Intelligent Investor by Benjamin Graham will teach you the essence of long-term investment strategies, the importance of financial analysis, and the concept of value investing. In this video, I will talk about 7 the most important ideas from the book that will help you understand the distinction between investing and speculating, the importance of margin of safety, and the advisability of being conservative in financial estimates and decisions. By following these simple steps, you can be completely confident that you are on the path to achieving financial freedom. With no further delay, I will begin with first one, the strategy of intelligent investing. Investing can make you a lot of money, but you can also lose a lot. There are many stories about people like Warren Buffett who got rich by picking the right companies to invest in. But there are just as many or even more stories about people who lost everything because they invested in the wrong things. So we have to ask ourselves, is investment really worth the risk? The answer is yes, as long as you follow the strategy of intelligent investing. Intelligent investors use thorough analyses in order to secure safe and steady returns. This is very different from speculating, in which investors focus on short-term gains made possible by market fluctuations. For example, a speculator might hear a rumor that Apple will soon release a new hit product and would then be motivated to buy lots of Apple stocks. If she's lucky, then this knowledge will pay off and she'll make money. If she's unlucky and the rumor proves wrong, then she stands to lose a lot. In contrast, intelligent investors focus on pricing. These investors buy stock only when its price is below its intrinsic value, its value as it relates to a company's propensity for growth. If you're an intelligent investor, you'll only buy a stock if you think you're getting it for less than what it'll be worth later as the company does better. Imagine this margin of safety, like when you're shopping. A pricey dress is only a good buy if you're going to wear it for a long time. If it's not good quality, then you're better off getting a cheaper one that'll last just as long. Second idea, 3 principles of intelligent investing. There are 3 principles that apply to all intelligent investors. First, intelligent investors analyze the long-term development and business principles of the companies in which they're considering investing before buying any stock. A stock's long-term value is not arbitrary. Rather, it depends directly on how well the company behind it performs. So, be sure to examine the company's financial structure, the quality of its management, and whether it pays steady dividends, the distribution of profits to investors. Don't fall into the trap of only looking at short-term earnings. Look instead at the big picture by examining the company's financial history. These steps will give you a better idea of how well a company performs independent of its value on the market. For instance, a company that isn't currently popular but shows promising records, has earned consistent profits, is likely undervalued, and would thus make a prudent investment. Second, intelligent investors keep themselves safe from big losses by spreading their money across different investments. Don't put all your money into one stock, even if it looks really good. Think about how bad you would feel if the company you put all your money into was suddenly in trouble for tax fraud. Your investment would drop in value right away, and you'd lose all that time and money for good. By spreading your money around, you make sure you don't lose it all at once. Third, intelligent investors understand that they won't pull in extraordinary profits, but safe and steady revenues. The target for the intelligent investor is to meet his personal needs, not to outperform the professional stockbrokers on Wall Street. We can't do better than those who trade for a living, and we shouldn't be aiming for fast money anyway. Chasing dollar signs only makes us greedy and careless. Third, the importance of stock market history. Before you start investing, don't just focus on how a single stock has performed in the past. Yes, that's important, but it's even more crucial to understand the stock market's overall history. When you look back, you'll see that the stock market naturally goes through highs and lows. These changes often come without warning. This means investors have to be ready in terms of money and mindset. Big economic downturns, like the big stock market crash in 1929, are bound to happen every now and then. You need to ensure that you can take a big hit and survive. This means that you should have a diverse stock portfolio, so your investments don't all get hit at once. What's more, you should be mentally and psychologically prepared for crisis. Don't sell everything at the first sign of danger. Remember instead that even after the most devastating crashes, the market will always recover. And while you can't predict every crisis, looking at the history of the market will give you a better idea of its stability. Once you've determined that the market is stable, focus on the history of the company in which you'd like to invest. Look, for example, at the correlation between stock price and the company's earnings and dividends over the past 10 years. Then consider the inflation rate, the rise in prices generally, in order to see how much you'd really earn, all things considered. For example, you calculate a 7% return on investment within 1 year, but if inflation is at a 4% rate, then you'll earn a return of only 3%. Think carefully about whether it's worth the effort for only a 3% return. Knowing history is a powerful tool for smart trading, so make sure to keep that knowledge sharp. Fourth, the illusions of Mr. Market. To understand the whims of the market, it's sometimes easier to imagine the entire stock market as being a person. Let's call him Mr. Market. As far as people go, Mr. Market is unpredictable, very moody, and not very clever. Mr. Market is easily influenced, and this causes him to have major mood swings. You can see this in practice in the way the market always swings back and forth between unsustainable optimism to unjustified pessimism. When a new iPhone is released, for instance, people lose themselves in their excitement. Mr. Market is no different, and we see this reflected in the stock market when something exciting is about to happen. Prices go up, and people are more willing to overpay. As a result, when the market is too optimistic about future growth, stocks become too expensive. On the other hand, sometimes the market is too pessimistic, warning you to sell in unwarranted circumstances. The intelligent investor needs to be a realist and stop himself from following the crowd. He should likewise ignore the mood swings of Mr. Market. Moreover, when Mr. Market is happy, he makes you see future profits that aren't really there. Just because a stock generates profit in a given moment doesn't necessarily mean that it will remain profitable forever. Quite the contrary. Stocks that have been performing well are more likely to lose value in the near future because demand often inflates the price to the breaking point. Even with this knowledge, it's very easy to get tempted by quick profits because we're naturally good at spotting patterns, especially ones that seem to predict good outcomes. Actually, people are so skilled at finding patterns that even when shown random sequences and told there's no pattern, they'll still look for one. In the same way, when we notice profits going up and up, we fool ourselves into thinking this is a pattern that will keep going. Fifth, how to create a safe, balanced investment portfolio. As you begin your investment journey, choosing a strategy that fits your personal style is crucial. You'll need to decide whether you're a defensive investor or an enterprising investor. For now, we'll focus on the defensive investor. The defensive investor hates risks. Safety is his main focus. This safety can only be achieved if he diversifies his investments. First, you should invest in both high-grade bonds, things like AAA government debt securities, as well as common stocks, by which your share of the company translates to voting power for major business decisions. Ideally, you should make around a 50-50 split between the two, or for the extremely risk-averse investor, splits of 75% for bonds and 25% for stocks are acceptable. Stocks and bonds have different degrees of safety and profitability. Bonds are more secure but produce less profit, while stocks are less secure but can lead to greater rewards. This kind of diversification accounts for both tendencies. Second, your common stock portfolio should be likewise diversified. Invest in big, well-known companies with long histories of success, and try investing in at least 10 different companies to reduce the risk. Diversifying your investments might seem like more effort than you expected, but there's an easy way to simplify it. Use the strategy of simplicity in choosing. When picking stocks, you don't have to start from scratch. Check out what successful investment funds are doing and model your choices after theirs. This doesn't mean just going with the trend and picking whatever is popular. Instead, find funds that have been successful over a long time and mimic their strategy. Lastly, always use the help of a professional. They understand the ins and outs better than you do and can help you make the wisest investment choices. If you stick to these basic rules, your careful approach will eventually pay off with positive outcomes. Sixth, how to create an aggressive investment portfolio. To become a successful enterprising investor, you'll want to employ many of the same strategies as defensive investors. Just like a defensive investor, you will divide your funds between bonds and common stocks. Whereas the defensive investor will most often opt for a 50-50 split between stocks and bonds, the enterprising investor will invest more in common stocks, as they are more profitable, yet riskier. And just like the defensive investor, enterprising investors should also consult a financial planner. However, the enterprising investor sees his financial planner not as a teacher, but rather as a partner in managing his money. That is, he is not led by his financial planner. They make decisions together. In addition to using bonds and common stocks as the base for their portfolios, enterprising investors will also experiment with other kinds of stocks that have higher risk and higher reward. For example, you might have heard about a new startup that you think could become the next big thing, similar to Google. This means it's a great chance. If you're an aggressive investor, you can choose to invest in this company, taking a chance, but you should only use a small amount of your money. No matter how exciting or promising an investment opportunity seems, enterprising investors should limit these stocks to a maximum of 10% of his overall portfolio. Keep in mind, smart investors can make mistakes, and sometimes the market is just too unpredictable for anyone to guess what will happen next. That's why it's important to set boundaries to safeguard our finances against economic slumps or bad investment choices. And just as defensive investors do, enterprising investors must remember that ongoing research and keeping an eye on their investments is key to keeping the money coming in. And seventh, do not follow the market's ups and downs. If the price of stocks you own drops, do you sell right away or hold on to them? And if another stock's price is going up, should you buy it quickly before it's too late? This style, called market trading, is common among investors who worry they'll lose money if they don't follow the crowd. But an intelligent investor knows there's a better way. Trusting Mr. Market is dangerous. If a stock's prices are climbing fast, then chances are that it's either already more expensive than its inherent value, or it will make a risky investment. Do you remember the US housing bubble only a few years back? Everyone kept investing in housing, and as prices continued to climb, nobody realized that prices were already totally unrepresentative of their intrinsic value. Once this became too obvious to ignore, the entire market crashed. To avoid this exact scenario, enterprising investors buy in low markets and sell in high markets. Check on your investments often and think about how the companies you've invested in are doing. Ask yourself, are they being run well? Are they making money? If you see that a company's stock is going up in price but doesn't really deserve it, it's smart to sell it before the price falls. On the other hand, you'll want to buy in low markets. That's exactly what Yahoo did in 2002 when it bought Inktomi Corp. for only $1.65 per share. It was a sensational bargain. Mr. Market had become depressed after Inktomi's shares fell from the seriously overrated $231 per share at a time when the company wasn't profitable. In the end, I would like to say that whether you want to play it defensively or go the way of the entrepreneur when it comes to stocks, you always want to walk the path of the intelligent investor. All you have to do is follow the guidelines laid out here, and you too can turn your investments into modest but steady profits. Thanks everyone for watching. If you found it helpful, please leave your like and subscribe to my channel.